Hello everyone, this is Super Accounting channel. If you are new here and you haven't subscribed yet, please be sure to subscribe to this channel. Give me a thumbs up if you like the video. Comment in the comment section for me to know more. Today we'll be talking about a very important topic in accounting, and that is basic accounting. Basic accounting. And our outline here is the definition of accounting, the branches of accounting, users of accounting, elements of financial statements, and the components of financial statements. Stay tuned for me to give you the details of everything I have done today. So we will go to the definition of accounting. What is accounting? Accounting basically means the process of collecting, recording, evaluating, and communication of economic events in monetary and non-monetary terms to permit informed decisions by users. What is collecting? When we talk about collecting in accounting, what does it mean? It basically means gathering of data, grouping of the data into meaningful information. Recording. Recording basically means bookkeeping, writing them in the books. Evaluating basically means analyzing the data into meaningful information, putting figures on it, and also making it useful for users to understand. Communication basically means transmitting the information of the data used from one person to another, or from one part to another, from the management to the users, or from the organization to the users. It is mostly in monetary and non-monetary term in a form of explanation. So we will quickly look at the branches. Science has branches. Other other fields also have branches. So accounting has also has branches. So we have three branches of accounting. That is cost accounting, management accounting, and financial accounting. But people normally think that the financial accounting is the only one. It is also a branch of accounting. So I'll explain the three branches and then we'll move on. So management accounting. What is management accounting? Management accounting basically talks about providing financial information to managers um, to make informed decisions. So providing information such as budgets for them to predict into the future what they'll be doing or what will be happening. And it's basically internal only. It's basically internal. They use it by management. So it is used by management, sorry. So cost accounting, what is it? Cost accounting basically talks about recording costs incurred in the organization. An example is purchasing raw materials. So it can be in a form of direct or indirect form. So the direct one is maybe purchasing raw materials. And then the indirect one can be the salaries and wages of the managers in the organization. So we will look at the financial accounting. What is financial accounting? It is basically the process of recording, summarizing, and reporting an organization's business transactions, the business transactions in a financial statement form or through a financial statement. So their business transactions, their day-to-day activities, it is being recorded in the financial statement. And then they will do it in a summarized form, in a concise and understandable way. So we will quickly run into the users. Who the users, those that use the financial statement, who are they? We have internal users and also external users. The internal users, an example, one of them can be employees, shareholders, it can be management, etc. The external ones too can be the media, the government agency, the banks, the lenders, those who lend money to the organization. It can be regulatory bodies and so on. But today we are just narrowing it down to five of them, and I have mixed it both internal and external. So shareholders are internal users. So before they even someone asks you, list on or explain the users of accounting, you have to know the name of the user, their definition or who they are, and also their need. So you have to bear in mind three things you have to know here. So the shareholders is one. So they are the owners of the business. Shareholders are the owners of the business. They contribute their capital for the smooth running of the business. So if a shareholder is looking at the financial statement, what is he looking at? They are what? To measure the performance and to decide whether to liquidate or to expand the business. That is their aim. To know whether the organization is performing well so that they will either they will invest more into the business to expand, or they will liquidate the business by collapsing it and taking their monies and sharing, or they can decide that no, let me take my money and leave the business. So this is why they need the financial statement. We'll go to the customers. Who are customers? We have all been customers before, one way or the other. So a customer is a person, or they are people that buy from the business. So when we say a customer, what does he need or what do they need in the financial statement. So their own is to know whether their business is financially sound so as to have confidence in them. They want to know whether the organization can be there for a long period of time so that when they know they are buying their products here, this is where I'm buying it for a long period of time. I'm not changing it to maybe going somewhere else to buy it. You understand? So their aim is to focus on one supplier or one organization to produce their product or to provide them with their products. That is their aim. So if the organization is not performing well, then they will know that this organization they can run into loss and liquidate. So let me go to a company that is well trusted. You understand? So we will go to the employees. Who are employees? Employees are the workers of the organization, and they are the people that use their skills, their talents, and then their energy to provide revenue for the organization. So what do they need in the financial statement? Their main aim is to know whether the firm is capable to survive and pay higher salaries. Every employee wants to get his salary regularly and then on time. So what would they need? They want to know whether the organization is performing so that if they are not performing, then they'll have a plan B by moving to another organization to seek for employment there. So, and also they want to know whether the organization can pay them higher salaries in the near future. You understand? So, government agencies such as the GRA, the Ghana Statistical Authorities, the GRA like this, they are there for you to pay them taxes. So, if you are an organization's financial statement is there, they want to know whether the amount the organization can pay as a tax. So suppliers, who are suppliers? They are the ones who sell materials to the firm for a smooth operation of the business. So an organization can purchase raw materials from someone. That person they purchase from is the supplier. So sometimes they purchase it on credit. So that supplier will want to know whether you should trust them by giving them the goods, whether they will pay back or not. If they are not able to, if he sees that they are not capable of paying back, then you would not give them the supplies or the products they need at all. You understand? So we'll quickly move to the elements. What the organization, the financial statements, entails. So the elements, they are five. And then my acronym for it is Real E, REALE. So the R is revenue, the E is expenses, the A is assets, the L is liability, and the last E is equity. So real E. So let's see how the real E is explained. So, an asset, the A, is a resource controlled by an entity as a result of past events, and the future economic benefit is expected to flow into the entity. So, if they said a resource is controlled by an entity, what does it mean? The entity may not necessarily be the one that purchased that item or that resource, but it could be that they are the one in charge of it now, in charge of it, controlling it now. So they have to record it as an asset. An example is building or motor vehicle. A building, let's say an organization has leased or has rented a building for their business for 50 years or for 25 years. That building should be recorded in the financial statement because it is controlled by them. And then they said a future economic benefit is expected. You should get a benefit from what you are operating or the resource you are controlling. You understand? So when you are not getting any future economic benefit from it, then it is not an asset. It cannot be classified as an asset. So we go to liabilities. Liabilities are the obligation of an entity to transfer an economic resource as a result of past events and an outflow of resources expected. When we talk of obligation, what is it? Obligation basically means the duty of an entity or of an organization to transfer resource, to send resource out, to take resource from the organization to another party. So sending resource to another party simply means that there will be an outflow of resource. So if there will be an outflow, it will be classified as liability. Example, loan. An organization has gone to secure a loan. Though there will be money coming in, but in the future, they will have a duty to fulfill or pay back that loan. So that duty is what we call an obligation. And then it is classified as a liability. So bills payable as well. Bills payable such as electricity bill or water bill is a short-term liability, and then the loans are long-term liability. So we'll go to expenses. What are expenses? Expenses are the costs or money spent by the business in their effort to generate revenue. They are the expense or the money spent by the business in the effort to generate revenue. Example, wages and salary. Wages and salary of an employee. The employee is the one providing his skills, his talents, and then his energy um, to help you generate money. So the money you pay him, it will not be classified in anywhere than expenses. It will be classified as an expense. That is why it is here. So equity, what is equity? Equity is basically the total cost or resource supplied by the owners of the entity, the owners of the business. Basically, it talks about the shareholders. The shareholders, the monies they have contributed, the total money they have contributed so far um, to run the business. So we go to revenue. What is revenue? Revenue is the total money generated as a result of ordinary operations of the business. Ordinary operations of the business. It simply means that the money you have generated from your normal business you are doing. An example is an organization selling spare parts. They are selling spare parts. So the money they derive from the sale of that spare parts is what we call revenue. So it will be classified as revenue. So we will finally look at the components. What the financial statement is about. So there are also five components. They are composed of five. So the first one is income statement. The second one is financial position, statement of financial position. It can be called as balance sheet as well. Statement of changes in equity, cash flow statement, and the notes to the financial statement. When we talk about income statement, what do we mean? Income statement basically means the revenues and then the expenses of an organization. So um, the elements we saw revenue. So the revenue classification will be under income. The expenses will also be under income. So income statement. So the next one is financial position. The financial position too will look at the A, the L, and then the E. The first R and the E is for income statement, and the last three words are also for financial position. Basically, that is how it is done. So the assets, the liabilities, and then the equity or capital that will go to the financial position. Now let's look at the changes in equity. Changes in equity basically means the movement in the capital contributed by the shareholders. So we'll look at that into details later. Cash flow statement basically talks about the inflows and then the outflows of an organization. So let's say outflows, an organization has purchased an asset, let's say a motor vehicle. The motor vehicle purchased, money was used. So that money that moved out of the business is called an outflow of resource. So we record it as outflow and the outflow. And then maybe they have an asset and they are selling it. That sale of assets or disposal of assets is called an inflow because they are getting money as they are selling that asset. So they will be recorded as cash inflows and cash outflows. You understand? So the last thing we will do today is note to the financial statement. It looks at the summary of all these four, the explanation, how the methods they used, the inventory valuation methods they used, the depreciation methods they used, the IASs, all of them are classified under notes to the financial statement. They are explained into details there. So today, what we learned is the definition of accounting, branches of accounting, users of accounting, elements of financial statement, and the components of financial statement. So I hope you learned a lot today. So I will be glad if you give me a thumbs up. If you subscribe to this channel and then you comment in the comment section as well. I'll see you in my subsequent videos. And then I hope, thank you very much. And then have a blissful day. I love you all.